To understand the difference between different stock order types, let's start with the easiest one, which is the market order. A market order means you will buy or sell your stock at the current market price. Think of it as you saying to the broker, look, I want this stock immediately, so just buy it for whatever price is available right now. The benefit is that you'll get the order filled quickly, but the price might vary slightly from what you can see on the screen when you buy it in your broker. Hello finance people, my name is Robert and I'm here to share with you my learnings and experiences about personal finance as a European.
So I'm here in Trading 212 and this is the Apple stock, and let's say I want to buy it. Here are the order types that we're going to cover today as well. In some format, there are all of the platforms. Interactive Brokers, Digiro, Trade Republic, all of them have some way to select this. So the market order is pretty simple. All you have to do here is select market, and now you can say, let's say I want to buy a number of shares. So I want to buy 5 shares. It's going to cost me this much. And if I click on this now, and I'm not actually using real money on Trading 212, you can have practice. So if I just buy it now, you can see that it will send the buy order immediately. You see, order placed, pay attention, 22194. And if you see here, the fill price was actually 222.05 cents. So that's about 15 cents more than what it was showing on my screen before. But it got executed almost immediately.
Also, if the stock is very volatile and it just jumps around like this, it could happen that when you set a market order and at the same time the stock jumps by 5%, that you would pay that extra 5% and not what you saw in your broker. That said, most of the time this is not an issue and it will just execute the order close to what you see on your screen. But for volatile stocks, keep this in mind or use a next order type, which is limit order. When buying a stock, it lets you set the maximum price you're willing to pay for a stock. It's like saying to your broker, okay, I'll buy this stock, but I will limit it to $50 or less. Yeah, remember this, 50 or less. Well, if you're setting a limit order for when buying a stock and you set it to $50 and the stock price is somewhere here, let's say it's 55, it fluctuates here until it reaches this point when it gets triggered. That's the limit order. And just keep in mind that if you set the limit order above your price or the current price, it'll just get executed immediately.
When it comes to limit order, you can see I've selected the Apple stock again and we have limit here. Here we select how many shares. Let's say it's the same 5 and then the price I'm looking for. So this is the maximum price you're willing to pay per share. So let's say that's 219. So you see that's a €3 difference. And expiration, I'm going to set to never, but you also could have end of the day. Or on some platforms, never is called GTC, so good till canceled. And you have also end of day on all of the platforms. And now, basically, if I just hit this button, this order will wait until it hits this price. One thing about the expiration is that it doesn't always mean that it's never. So I've gathered here the most popular platforms, and this is what they say on their pages, but please make sure you double check when you're looking into this. I cannot guarantee these are correct, but basically this is, for example, for Trading 212, they say that it's never. However, for Interactive Brokers, it's 90 days if you do not log into your Interactive Brokers account. So you can see that each of them have slightly different interpretation of what never or good till canceled means.
On the other hand, when you want to sell your stock, limit order lets you set a minimum price you're willing to receive for a stock. So you tell your broker, I'll sell this stock, but I limit it to 100 or more. So I want to get more money. So when it goes up, I get more money for it. So basically, you set here $50 and the price is right now somewhere here. Whenever it reaches high enough, it'll trigger that order and it gets executed. And again, if you set the limit price on when selling the stock below the current price, then it'll get executed directly.
If I'm selling this Apple stock and I want to have a limit order, then I can again select the amount of shares I want to sell. I have 5 right now, so I can sell all of them. And from here, I can choose the price. Again, set the minimum price you're willing to get per share. So that means we need to set the price above this price. So let's say once it hits 250, I want to just take it out because I'm happy with my profits. And then it will execute this order. So then I could just send the sell order by clicking on this button. But again, it's not going to get executed until we reach that price of 250.
The way I like to think about this is that the limit order is always in your favor. You want to buy your stock for less money and sell it for more. Just keep in mind that the limit order might never go through unless the market reaches your specific price, or the order could be partially filled. This can happen if the price bounces close to the limit price and then it only has time to execute part of the order. Let's say you want to buy 1,000 stocks. The broker then finds one or multiple sellers that are willing to sell their stock for that price. So you might be buying 300 from one seller and 700 from the other one. This is all done automatically, but I want you to understand how it works. So you don't, if you send out for 1,000 stocks, it doesn't mean it gets it from one seller. It might be dispersed across 1, 2, 5, 10. It really depends what it can put together. And by the way, I've started a newsletter where I share my thoughts about investing in personal finance from a European perspective. For example, in a few editions back, I dove into whether you should invest in euros or dollars when buying a US stock. If you want to receive this weekly newsletter, just sign up. The link is in the description. The next order type is kind of opposite of limit order, and it's called stop order, or often referred to as stop loss order when you're selling your stock. And I just want to warn you, this will mess a bit with your brain. So just mentally prepare for it. It's going to make sense at some point. When buying a stock, stop order lets you set the minimum price you're willing to pay for a stock. You're basically telling your broker, I want to buy the stock, but only if the stock reaches 50 or more. Only then buy it. So limit order was 50 or less, and stop order is 50 or more. So let's take a look at the example. When it comes to stop order, let's say you set it to $50 again. In this case, the current price is under it, and it fluctuates here. And as soon as it rises high enough, you're gonna buy it, which kind of doesn't make sense. You're basically trying to buy something that when it's at higher price, but this is useful when you're day trading and you're trying to look for trends. And whenever it's up, going upwards, you can then execute this order.
I'm again buying this Apple stock, but now I've selected stop. And you notice I can choose the shares, so again 5, and here it says set a price above the current price that converts your order to a market order. So as soon as it hits, let's say 223, I wanted to buy the stock. So if I now hit this, it'll just go into my orders and it'll wait there until this is reached. It only buys it once it's at 223 euros.
Honestly, when I heard about the stop order first time, my brain got a little jammed. It's like, why would someone want to wait to pay more for the stock? But that's the thing. If you're a passive investor like me, you will probably never use stop loss orders when buying a stock. It's more meant for day traders who want to buy the stock if it's trending upwards. But stop order when selling your stock, that's a useful tool for mitigating risk for any investor. So when selling a stock, stop order lets you set a price at which you want to get rid of the stock. So you tell your broker, I'll sell the stock if it goes 100 or less, because I want to just cut my losses and sell it. That's why the sell stop order is often referred to as stop loss. It's like setting a safety net to limit your losses if the stock price drops below the stop loss price you've set. Let me show you how. So let's say you have the $50 mark here and you have the stock prices right now here, it fluctuates, and as soon as it dips below that 50, you sell your stock. And this is much more useful to pretty much every investor or day trader because you're able to limit your losses. And that's why it's sometimes called stop loss as well. So whenever it dips low enough, you just get rid of the stock because it's too much. I don't want to lose this much money. Just to be clear, on most brokers, once you bought a stock, you come to the same stock and then you set the stop loss on that part. So you're setting the stop loss on selling part, but you don't do it when you're buying the stock. But make sure to check if this is how to set up your stop loss orders in your broker. For example, in eToro, you set the stop loss while buying the stock.
And I'm again in the Apple stock, but I'm selling this time and I have stop order or stop loss selected, and I can select how many shares I want to sell. And now I get to say, set the price below the current price that converts your order to a market order. So when it hits certain price, let's say 200, only then it will start a market order. And this is a great way to just make sure you don't lose too much money or more money than you're comfortable with. So you can just set this order and it will now sit there until you have the 200, it reaches that 200 euros, and only then it gets executed. By the way, when I've spoken to some of my viewers in Europe, I've noticed that many people want to start investing, but they get stuck on all the details and overthink everything. That's why I've created the European Investing Fast Track training, which gives you a step-by-step system to skip the guesswork and start investing confidently in just a few days. If you're interested, there'll be a link in the description.
To summarize this and to make it easier to remember, you can take a screenshot of this. Basically, when you're buying a stock, the stop order is anything above that price you set, and limit order is anything below it. And when you're selling a stock, it's the opposite. You're basically saying limit order is anything above your set price and stop order is anything below it. I think the easiest way to remember the sell part is that you want to stop your losses, so you don't want them to go too much down. Then we have trailing stop loss, which is very similar to stop loss, but the level gets automatically adjusted based on dollar amount or percentage you set. So the price you set is dynamic. Let me quickly explain how this trailing stop loss works when you're selling your stock. So you have your stock price here, and let's say it's going up and down here, and there's new peaks constantly, and then at some point it just crashes. Let's say you set your stop loss here. This is the normal stop loss, not trailing stop loss. You would set it here, and you would say it's the $50. Whenever it goes below that, that's when you trigger it. But the way that the trailing stop loss works is that you set a proportional number. So let's say here, let's say I just say it's 10%. When it dips 10% from the peak, that's when you trigger the stop order. Here it rises to here, and the new level is at this point. So when it dips here, it doesn't get triggered, but it goes up here, and again, this is the new peak. And by the way, I'm just simplifying it here. These are the new peaks all the time. Whenever it's higher than previous price, then it adjusts upwards. So here it's again 10%, and this dip didn't trigger it. However, this is the new, and this is the new level for stop order. So basically here, whenever it crosses this line, that's when it gets triggered, instead of this line here. So you see the difference? With trailing stop loss, we got all of this profit here. We got it to ourselves because it was constantly adjusting to the new highest price. So very useful if you want to mitigate your risk, but also at the same time, gain as much profit as possible. So you see, with trailing stop loss, you're able to stop your losses even after the stock has first risen. So you don't need to keep a track and adjust the stop loss whenever the stock rises. It just does it automatically. This way, you just get more of that profit into your pocket.
Now, unfortunately, not all the platforms offer trailing stop loss. For example, in Trading 212, you cannot do it in the invest part of the platform, but you can do it in the CFD, which is more expensive and more riskier, but you're able to do it there. For example, here, I already bought NVIDIA, so I need to actually go to my positions. And then if I scroll here, you see NVIDIA open position. When I click on it, only then I can see the trailing stop loss option. So if I click from here, you can see that I can set the distance of trailing stop loss. So if I set this, for example, I have 139. So let's say 13. So this is the distance it will keep from the highest peak. So if, for example, this goes above the 13, let's say this goes to 160. That means the trailing stop loss will be adjusted to 160 minus 13, which is 147. And only if the stock starts dropping and it reaches that 147, then it gets executed. So from here, I can confirm the changes, and you can see that I set this trailing stop loss. So trailing stop loss is a little bit more complicated because not all platforms offer it, and some offer it, but it's a little hidden. So just take a look if yours actually even has it. For example, the Giro has trailing stop loss, but only for the German stock exchange. So there are limitations with these.
But just be careful with trailing and stop loss. I've had a few instances where I've set it, the trailing stop loss too low, and it got triggered just before a big rally upwards. This happened to me recently on Amazon stock, where it dipped before a huge increase, and it automatically sold all my stocks during this dip. And I didn't even notice it for a few months that it actually did this. And the last order type is stop limit order. This order combines features of both stop order and limit order. When the stock hits the stop price, it triggers a limit order instead of a market order. So basically, you're telling your broker, hey, I want to set a limit order of $90, but only once the price goes higher than $100. Let's look at an example when you're buying a stock. This makes more sense this way. The stock price is somewhere here. You're saying that, hey, I want to trigger this limit order, but only once it's above that 100 euro threshold or dollar. When it goes up until here, only then you trigger this. And it doesn't get, you don't buy the asset here. It basically waits for it to fluctuate for some time, and then once it dips enough for you to actually snatch it. Remember, stop order is always above, and then limit order is below when you're buying a stock. So that's why first there's a stop order, you wait for it to bounce to this level, and only then you set the limit order, which is below the price, because you're trying to catch it when it's bouncing between these two prices. So mostly useful for day trading, but it's good to know also if you're just a passive investor. When we talk about stop limit order on selling a stock, it's the opposite. So bear with me. So the price is somewhere here now, and let's draw this line for 110. So let's say we set the stop limit order as stop is 100 and 110 is the limit. So that means it fluctuates here. Then when it goes below this price, 100, which is the stop order, only at this point it becomes effective. And once the stock bounces around and it hits here, then you buy it as a limit order.
And just to show you an example here in Trading 2 and 2, I already am selling the Apple. I want to sell 5 shares and I already selected stop limit. So if I come here, I can set the stop. That is the price below the current price that converts your order to a limit order. So let's say it's 200. Once it hits that 200, we want to buy it if it goes above 210. So it's exactly the same situation that I just showed you in a graph.
Now, it might be a bit confusing, but for casual investors, you will probably only use market, limit, and stop loss. If you're planning to be a day trader, then you might use all of these order types. Now, I've been investing for the last 7 years, and there are a few mistakes that I really wish I hadn't made. Without them, my portfolio would have been probably double the size. That's why I created this video right here, so you can avoid losing time and money by making the same mistakes I did.